All right, folks, buckle up because we've got some red-hot tech scoops flying your way today, straight from the glossy halls of the NASDAQ. Our first big story centers around the ever-enigmatic software giant Microsoft, where the numbers are in, the charts are tallied, and investors have their powerful magnifying glasses aimed directly at Redmond's finest. So why is Microsoft grabbing the headlines today, you ask? Well, investors and finance nerds alike have been busy crunching the numbers, evaluating Microsoft's performance against its primary competitors in the always competitive software industry. As they sift through the data, several key metrics paint an intriguing picture of Microsoft's market stronghold, profitability, and growth potential. First up is the price-to-earnings ratio, holding steady at an admirable 31.42. Now, this charming number might sound like someone's lucky roulette pick, but what it really signifies is that Microsoft's potential for growth comes with a reasonable price tag, something investors adore, like cats do cardboard boxes. The PE ratio stands just 0.4x over the industry average, suggesting Microsoft might just be that bang-for-your-buck opportunity that investors are always diligently searching for. Next in line, the price-to-book ratio scoots into the discussion at 9.58. Leaning nicely below the industry average by 0.41x, Microsoft appears to be wearing an undervalued hat in terms of asset valuation, which could mean those clever number crunchers see some layered potential that might just make shareholders smile like kids on a merry-go-round. But the analysis doesn't stop there. It's going for the trifecta. The price-to-sales ratio, messing around at 11.13, tells an interesting tale. This ratio jumps 1.4x above the industry's average, hinting at a touch of overvaluation where sales performance is on the table. It's a saber dance between high revenues and high expectations, folks. Let's pivot to the financials that'll have you nerding out. Microsoft's return on equity, that's a fancy way to say how well they make profits from shareholders' equity, is a cushy 8.17%, sitting pretty at 0.76% above its rivals. Profits not only lean strongly on efficient equity use, but Microsoft's EBITDA showcases a brawny $36.799 billion powerhouse, zooming a gigantic 56.6x above the norm. Microsoft's got strong bones with a skeleton of $47.83 billion in gross profit, 35.17x higher than the industry's vitamin D-deficient norm. Yet revenue growth is fluttering a bit lower at 12.27%, shortchanging the 12.5% industry parade butterflies by just a smidge. Lastly, let's toast the company's solid backing with its low debt-to-equity ratio, a healthy 0.21 sparking envy across boardrooms. Microsoft steers clear of an all-debt road trip, maintaining a golden balance that states confidently, "We have whatever it takes gumption," in the lifeline that is financial health. As the echoes of investor calls fade, one thing remains clear. While Microsoft wears some scars of a challenging sales vista, its efficiencies in profit, equity mastery, and market standing have earned it a spotlight, leaving an undertone word: potential. Let's see if they conjure some magic to give their revenue its caffeine kick. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.